The United States and China are locked in a trade war. It began in 2025 with a series of tariffs. The United States imposed tariffs on Chinese goods, and China retaliated with tariffs of its own. This back-and-forth escalation has strained the global economy. The trade war stems from long-standing U.S. concerns. The United States claims unfair trade practices from China, including intellectual property theft and forced technology transfers. The Trump administration aimed to reduce the trade deficit and protect American jobs. The initial tariffs targeted a range of products focusing on Chinese manufacturing. China retaliated with tariffs on U.S. agricultural goods. These early salvos marked the beginning of a protracted trade conflict. The impact would be felt worldwide. The trade war has had a significant impact on both economies. Businesses and consumers have faced higher costs, and the dispute has created uncertainty in global markets. The trade war continues to evolve with each passing day. The trade war escalated quickly. In February 2025, the United States imposed a 10% tariff on a wide range of Chinese imports. The Trump administration also slapped a 25% tariff on steel and aluminum imports from all countries, including China. This move was aimed at protecting American steel and aluminum producers. However, it also raised costs for businesses that rely on these materials. China responded in kind, placing tariffs on $3 billion worth of U.S. imports, including agricultural products like pork and soybeans. These were carefully chosen to target U.S. industries and put pressure on the Trump administration. The situation further deteriorated in the following months. By April, the United States had imposed a 145% tariff on most Chinese goods. China retaliated with a 125% tariff on most U.S. goods. The tariffs covered a vast array of products ranging from electronics and machinery to agricultural products and consumer goods. The escalating tariffs led to higher costs for businesses and consumers, which in turn dampened economic activity on both sides of the Pacific. The trade war had become a lose-lose situation for both countries. Despite the tariffs, the U.S. trade deficit with China persisted. In 2024, the United States imported $439 billion worth of goods from China. In contrast, it exported only $143.5 billion to China, resulting in a staggering trade deficit of $295 billion. The trade deficit remained a point of contention for the Trump administration. It argued that the deficit was evidence of unfair trade practices by China. The United States demanded that China take steps to reduce the imbalance, including increasing purchases of U.S. goods, particularly agricultural products. China, however, maintained that the trade imbalance was a result of structural factors, such as differences in savings rates and consumption patterns. It resisted U.S. pressure to artificially manipulate its currency or make concessions that it deemed unfair. The persistent trade deficit underscored the complexities of the U.S.-China trade relationship and highlighted the challenges in resolving the trade war. The two economic giants remained locked in a stalemate, with neither side willing to back down. One of the main justifications for the trade war was protecting American jobs. The Trump administration argued that tariffs were necessary to shield U.S. industries and workers from unfair competition. However, the tariffs also had a negative impact on some sectors of the U.S. economy. Manufacturing jobs in particular were vulnerable. While the tariffs aimed to boost domestic manufacturing, they also raised costs for businesses, leading to job losses in industries heavily reliant on Chinese imports. The agricultural sector also suffered as China imposed retaliatory tariffs on U.S. agricultural products. The tariffs imposed on steel and aluminum imports also had ripple effects throughout the economy, raising costs for industries that use these materials, such as construction and automobile manufacturing. This, in turn, led to higher prices for consumers. The impact on the U.S. job market was complex. While some sectors benefited from the tariffs, others experienced job losses. The overall effect on employment remained a subject of debate. However, it was clear that the trade war created uncertainty and disruption in the U.S. labor market. Section 5. Clean energy caught in the crossfire. The trade war between the United States and China had significant implications for the clean energy sector. Both countries are major players in the global clean energy market. The tariffs and trade restrictions disrupted supply chains, raised costs for businesses, and created uncertainty for investors. One of the most significant impacts was on the solar energy industry. The United States relies heavily on China for solar panels and components. Tariffs on Chinese solar products increased costs for U.S. solar developers and slowed down the growth of the industry. The electric vehicle industry also faced challenges. While the United States has a growing domestic EV manufacturing base, it still relies on China for some critical components such as batteries. Tariffs on Chinese EV batteries and components increased the cost of EVs in the United States, potentially slowing down the transition to electric transportation. The trade war also highlighted the importance of diversifying supply chains for clean energy technologies. The United States and other countries began exploring ways to reduce their reliance on China for critical clean energy components and materials. This included investing in domestic manufacturing capacity and fostering partnerships with other countries. Section 6. Fossil fuels, a trade disrupted. The trade war had a mixed impact on the fossil fuel industry. China was a significant importer of U.S. oil and gas. However, the tariffs disrupted this trade flow. China reduced its purchases of U.S. energy products. This forced the U.S. to find other buyers for its oil and gas. The trade war coincided with a period of volatility in global oil prices. The collapse in oil prices, driven by factors such as the COVID-19 pandemic and oversupply, had a more significant impact on the U.S. oil and gas industry than the tariffs themselves. The trade war did little to dampen China's appetite for fossil fuels. China continued to import oil and gas from other countries such as Russia and Saudi Arabia to meet its energy needs. The trade war highlighted the complex relationship between trade, energy security, and climate change. While the U.S. aimed to promote its energy exports, the global shift towards cleaner energy sources continued. Section 7. The battle for rare earths. Rare earth elements are a group of 17 metals. They are essential for various technologies. These include smartphones, electric vehicles, and defense systems. China dominates the global rare earth industry. It controls the majority of rare earth mining and processing. In response to the U.S. tariffs, China threatened to restrict rare earth exports to the U.S. This raised concerns about potential disruptions to U.S. industries that rely on these critical materials. The U.S. government recognized the strategic importance of rare earths. It took steps to reduce its reliance on China for these materials. These steps included investing in domestic rare earth mining and processing capacity, as well as fostering partnerships with other countries that produce rare earths. The battle over rare earths highlighted the vulnerability of global supply chains to geopolitical tensions. It also underscored the need for countries to secure access to critical minerals and materials. Section 8. Macroeconomic waves. The trade war generated significant macroeconomic uncertainty. The escalating tariffs and retaliatory measures dampened business confidence and investment. This had a ripple effect throughout the global economy. The trade war contributed to a slowdown in global economic growth. The International Monetary Fund downgraded its global growth forecasts multiple times, citing trade tensions as a key factor. The trade war also fueled volatility in financial markets. Stock markets experienced swings as investors reacted to news of escalating tariffs and potential trade deals. The trade war highlighted the interconnectedness of the global economy. It demonstrated how actions taken by two large economies like the US and China could have far-reaching consequences for businesses and consumers worldwide. Section 9. The long road ahead. The US-China trade war has had a profound impact on the global economy. It has disrupted supply chains, raised costs for businesses and consumers, and fueled uncertainty in financial markets. The long-term implications of the trade war are still unfolding. The tariffs imposed by both countries are likely to remain in place for the foreseeable future. This will continue to create challenges for businesses and reshape global trade patterns. The trade war has also accelerated the trend of decoupling between the US and Chinese economies. Both countries are seeking to reduce their reliance on each other for critical goods and technologies. This decoupling could lead to a more fragmented global economy, with separate supply chains and technological standards. The trade war has highlighted the need for greater cooperation and dialogue between the US and China. Resolving the underlying trade disputes and finding ways to coexist peacefully will be essential for ensuring global economic stability and prosperity in the years to come.